A lot of retired investors use CDs or a technique called bond ladders in order to sequence out their income and cash needs for the short term, like the next 5 to 10 years. And there's an advantage to bonds in that it's very predictable and you get a source of income that can be a lot less risky than the stock market. That's a good thing. But doing this kind of technique can be time-consuming, expensive, and also doesn't give you a lot of diversification if one particular bond doesn't pay you back. Enter defined maturity bond funds, or sometimes called target maturity funds. And this is just an ETF that owns hundreds of individual bonds that all mature in a particular year. That means that a year, like say 2025, in which these bond funds all come due, will provide you with cash and income needs for that particular time period, and that really helps you as you're plotting out your lifestyle needs if you have goals for a certain amount of income throughout retirement. They're also advantageous because they're very low cost, usually less than 1/10 of a percentage point per year. They offer you tons of diversification because there are hundreds of bonds in each fund, and they're very simple. You're just buying one thing in your investment account. One further advantage that we've seen this year is that it reduces what we call interest rate risk. As the Fed and markets have been going up and down in terms of what bond values are, you don't see any of that kind of issue with these bond funds. You know what you'll be paid back in a particular year with that interest amount. That's an advantage for retirees who are trying to build out their income needs for their lifestyle. Please reach out if you have questions about bond funds or defined maturity bond funds, and we'd love to help you with your income plan throughout retirement.